Good morning, everyone. Today we're going to continue our discussion on portfolio optimization. So last time we started with using the quick quant mode add-on package in order to simplify the creation of a returns portfolio. And we reached up to a certain point in our discussion. Okay, we reached up to this point where we were extracting the optimal weights. Okay, so do you have this class? Do you still have this? Please open this file, and then we're going to discuss another one. Okay, so let's quickly review what we have done so far. I asked you to load quant mode, QMAO, performance analytics, tidyverse, tidyquant, and portfolio analytics. Now, for those of you who were not able to load QMAO because of some problems with your laptop, whatever we do here, whatever we did last time, you can do manually. Okay, so what we did, if you recall, class, the first thing that we did was to create this object tickers, okay, consisting of Apple, Google, etc., including GSPC. If you're going to use get symbols from quant mode, your GSPC has to be with the caret sign here, okay, because this will not run if it does not have caret. So if you're using get symbols, so we have learned that. Okay, let me first delete whatever I'm going to run again. Delete everything here. Okay. So you have this, so I'm not going to share this with you. How did I share it, class? I recall I shared with you a Word file, right? And then you copied it in RMD. Am I right, class? Am I right? Hello? Okay, good. All right. So this is the way to go when you would want to access stocks, especially those that are listed in Yahoo Finance, listed in U.S. indices, Nasdaq or Dow Jones, etc. You can make use of quant mode because quant mode will allow us to interface with Yahoo Finance. The stock prices are archived in Yahoo Finance. We're grateful that as of now, Yahoo Finance still allows us to access the stock prices using quant mode. Now, if you check Yahoo Finance now, finance.yahoo, you'll notice that you can no longer download the data directly from finance.yahoo. I checked it last week and I noticed that you cannot anymore download the data. So it's a good thing that R, particularly quant mode, has an interface with Yahoo Finance, so we're able to download stock prices. So here we download stock prices. Okay, the stock is tickers. We identify the start and the end date. Source is by default Yahoo, and by default it's also daily. Auto data sign is equal to true. We'll create objects with names that are equal to the ticker symbols. So if I run this, my environment is now empty. So this is just a quick review, class, of what we did last time. And in fact, we have done this several times. You can see that it started with creating this vector and start, okay? And then it generated the XS objects for the stocks. And we were able to download also S&P 500. But notice that the name of S&P 500 here is GSVC. But when you download it from Yahoo Finance, you have to use the caret symbol because that's the ticker symbol of Standard & Poor's. Okay, then from there, what we can do is, okay, we said that from here you can extract, let's say, the closing prices of Apple, Google, and combine it into one. So that will be another step. Okay, and then get the returns, okay, daily returns or log returns. That will be another step. So it's quite tedious to do those several steps. Good thing there's a package called QMAO because we can automatically get the prices already, our preference. Here we're using adjusted. We can download the closing prices or the open, high, or even the lowest, etc. So we use the QMAO, in particular the PF. This is a price frame, uh, price frame function. Okay, I think I have to run first. I haven't run this. I'll run this first. Make sure that you run also your packages because our functions will not work without the loaded package. Okay. So once this one I have to clarify because I noticed some of you running this before in case QMAO does not load. Okay, so you can use the repository, okay, or this also, another way to load QMAO. Okay, so you can go to the repository itself. The it's housed in the GitHub of in this GitHub. Okay, so we can make use of the PF, okay, PF function where it will generate an object. We named it PF. It will generate objects, the adjusted prices of Apple, Google, etc. And notice here, if we're using PF, we do not put the caret symbol here. Okay, the caret symbol is used when we're using get symbols from quant mode. Okay, so if I run this very quickly, PF, it generates a the printout here. So these are our stocks, and then these are the adjusted prices. So very convenient. In fact, we can go one step further because we can use the here. Okay, so after getting the prices, then we create an object to get the log returns. But we said that there's a faster way. This time we use the RF, returns frame. Okay, it will now generate a frame, an XTS object. We're using the adjusted prices and the type is continuous. Continuous means log returns. Okay, so if I run this and view the RF function, RF object, control enter. Okay, tickers1 does not exist because I haven't run this. I created this object, tickers1, and again, it contains the names of the stocks, and then again, no caret for GSPC. Okay, run this, and then run the RF, control enter. And notice, class, I'm going through this very quickly because we have discussed this last time. This is just a quick review. Okay. All right. Then the RF, okay, the RF has NA values at the start because if you recall, the formula for getting the log returns is the log of the current value minus the log of the previous value. Okay, or that's log of current divided by previous. Okay, so we just subset the RF, the return frame, and then we remove the first row, which contains the NA values. control enter, and then our RF object now contains the log returns, okay, contains the log returns and no more NA value. Okay, thank you. All right, let me pause for a while and maybe have some questions, clarifications. I'm going through this quickly because we already discussed this. This is just by way of review. Okay, any questions about this class? Okay, no questions. Okay, good, thank you. Now, we said that when we're modeling portfolio optimization, when portfolio optimization seeks to create portfolios, when you say create portfolios, is to assign weights to your assets, okay? Assign weights to your assets so that you meet a particular objective. So for example, your objective can be to maximize returns. So what will be the weights of your assets so that it generates the maximum returns? Or minimize risk, minimize standard deviation. So what will be the weights of your assets so that you're minimizing risk? Or it can be a combination of these objectives. Okay, so we're just going to use a two-asset portfolio. So we said that this is our portfolio. Portfolio one is the returns, our returns returns XTS object, RF, this one. And then let's just use a two-asset portfolio. So Apple and Google, the first two. That's why here we have RF subsetted 1 up to 2. And we said that this one pertains to the row, so it should include all the rows. Okay, the number of returns is 2262. Okay, so when we create this object port 1, it will also contain 2262 because all the rows are included. So let's run this port 1 and let's view port 1, control enter. So port 1 will only consist of Apple and Google with 2262 rows of observations. Okay. All right. So I hope you're following along, class. And then quickly again, this is just a review. We have to move on. Okay. Then to compute for the returns of a portfolio. So we have a portfolio now. It's port 1. And if we want to compute the returns of the portfolio, because this is daily prices, then you can have daily returns. Okay, but we have to identify the weight of each of the assets. So if this is 50-50, it means that it's just getting the average of Apple and Google because you're going to multiply this returns times 0.5 and this returns times 0.5. So as you know, it's just equivalent to getting the average of Apple and Google for this particular day and for the others also. So to get the return of the portfolio, we use from the package performance analytics, this function return the portfolio. Okay, so we create this object called portfolio one return, port one ret, and this is from the performance analytics, in particular the function return that portfolio. Then we have here port one, and then we identify the weights. So of course, it depends on how we would like to assign the weights. Let's just use a balanced portfolio, 50-50. Okay, so this is 50-50, and let's now get the, let's now view this object port one ret, control enter, and then it now prints out port one ret, okay? And this is now, you notice that it's only one. It's only one column because it generated the average of your Apple and Google. So this is now your returns, daily returns for your portfolio, assuming it's 50-50. Of course, you can change this. It can be 60-40, 70-30, etc. Okay, and then let's change the name. The name of our column is portfolio that returns. So let's just change it into port 50, 50 because it's 50-50. Okay, you can, of course, use any other name. Control enter. So this is column names, okay, which means that we're going to change the column name of port one ret. Okay, port one ret is this one. And now the column name has changed, port 50 underscore ret. Okay. Okay, and so this is the daily returns of our portfolio. we can estimate, we can compute the average return, annual return. Okay, this consists of several years. Okay, but what we do is to multiply the daily returns with 252 to get your average annual returns. Okay, so it's 22.27%. Our portfolio, equally weighted portfolio, earned over this period 22.27%. Okay, so last time we discussed rebalancing. Okay, I'll dispense with this class. We said that when you establish a portfolio, okay, and you set a specific uh, weight of the portfolio. Okay, for a 2-asset portfolio, you have 2 weights. For a 5-asset portfolio, you have 5 weights to to account for your 5 assets. So in the course of the quote unquote life of your asset, of your portfolio, the values will change. Okay? Because of market forces, the prices will change, and then the returns will change. Okay, so there will come a time when your portfolio might not have those original weights. It might no longer be 50-50, maybe it has become 70-30, etc. So if an investor would still want to maintain that that weight distribution for whatever reason, then he can do what we call rebalancing. Okay, so this function, okay, port 1 ret, and then I added this descriptor rebalance, okay, computes for the return of your portfolio. Same thing, port 1, 50-50, but we add this qualifier, rebalance on months. Okay, rebalance on quarter, rebalance on years, okay? But normally you do not do, of course, you do not do daily rebalancing because that's a very expensive proposition. Neither is months. Usually it's maybe quarterly, but that's also quite often. For others, it will be semi-annual or annual. Okay, so we can run this, and it will now create another object, portrait rebalance. Okay, so this is the object, and it has different portfolio returns compared to this one. For the first 30 days, it will have the same returns. Okay, because it will start rebalancing on at the end of the month. Okay, at the beginning of the next month, then it will start rebalancing. So that's when your port 1 ret and your port 1 ret rebalance will have different returns. Okay, so if you take a look at this, port 1 ret on February 1, okay, on January 29, this is the returns. Okay, these two, Control C, Control V. So this is the return on January 30, 29, and this one is on February 1. Well, this one, class, let's take a look at this. So January 29, I'll copy this, Control C. Okay, so you can see that the returns on January 29 are the same because that's the first month. And then once there was rebalancing, okay, you notice now that the returns are no longer the same. This is February 1. Okay, and February 1, henceforth, the returns will no longer be the same because this portfolio is set to be rebalanced every month. Okay, then we can compare the performance of your non-rebalanced and monthly rebalanced portfolio. Okay, we're using this. We're combining port 1 ret and port 1 ret rebalance and change the name to non-rebalance and monthly rebalance. So let's run this too. Let's run this all portrait. Okay, so I'll print this all portrait. There you go. This is the non-rebalance and this is the monthly rebalance. And we can compute for some metrics here. Okay, and it's table of annualized returns. Okay, so it will compute now table of annual rates returns, and there's a need to define the risk-free rate. So I'm just assuming here it's we can maybe let's put this. It's maybe this too high. Risk-free rate is average of 0.05 maybe. Okay, and then let's run this. Okay, so you can see that the non-rebalanced pale in comparison with the monthly rebalance. Okay, and the non-rebalance is riskier, 25.85%. This is standard deviation. This is 25.76, so the monthly rebalance performed better. So the annualized Sharpe ratio, assuming that the risk-free rate is 5%, the monthly rebalance is performing better. Okay, because the Sharpe ratio is just a measure of the uh, risk adjusted returns. Okay, that's the Sharpe ratio. Okay, all right. Of course, the figures would have been different if we change the rebalancing frequency of rebalancing. Okay, I hope you're following along, class, because we have discussed this. Okay, and in fact, we created a chart. We created a chart for that. Okay, so you can see the monthly rebalance is in the red. Okay, you can see in some points you can see the rebalancing starts here. Starts here at the end of the month. Okay, and then in some instances, the monthly rebalance is higher. Okay, you can see the red figure, which is the monthly rebalance. In some instances, it's lower. Okay, but overall, it generated higher average returns, average Sharpe ratio. Okay. All right. Then we started with this one last time, the portfolio optimization. So we said that to optimize portfolio, there are certain steps in order to follow. I have outlined here the six steps. Okay. So the first one is to create your portfolio, and we have done that. Our portfolio is port one. If you recall, port one is this one, consists of Apple and Google 50-50%. Okay. So that's our portfolio. And notice it's a portfolio of returns. Okay? When you do a portfolio optimization, what you're modeling is the returns and not the prices. Okay, so that's our object, port one. So the first step is always to generate an object. I call it a container. Okay, and in that container, you put on the elements of your optimization, portfolio optimization. So the first step is to create this portfolio.spec it's a container where you put all your specifications for your portfolio. So we have here port spec one, we call it port spec one. And then if we run this, okay, there, view port underscore spec one. Okay, you can see here what's contained here are the assets are Apple and Google because that's port one. And Apple and Google, based on the port one we created, it's 50-50. Okay, the others, the weight sequence, the constraints, objectives, don't have anything yet because we haven't placed anything there. So this one we're going to fill up, okay, by adding more information or more codes or instructions to our portfolio. Okay, so that's our step one. Okay, step two. So first you create the object, the container, and then we call that our portfolio specification. And then you put constraints, and then you put objectives, and then you run the portfolio. Okay, there are some terms that we have to remember, or we have to be familiar with in using the add.constraints function. Number one is a term of full investment. When we say full investment, it means that the total weights of your assets, for example, Apple and Google. When you say full investments, when you add weight one, which is for Apple, and weight two, which is for Google, they must add up to 100%. Okay, strictly 100%. So it cannot be 101%. It cannot be 99%. If we're strict about this, this is full investment. Okay. However, despite this, we can negate this by adding some other weights, like weight sum. Okay, so we can specify that the weight sum, it can get a lower value of 99% and a maximum value of 101%. Okay, this is done because oftentimes when this is our constraint, usually R and the software is not able to come up with a solution. Okay, so just take note that full investment is a very restrictive constraint, okay, where we are imposing that the weight should be 100%. We can relax it a bit by including this. Let's say, for example, the minimum can be 0.99 or 99%, and the maximum can be 101%. Sometimes this is conveniently done because if we don't do that, R will not be able to generate a solution for this very restrictive condition that the sum of the assets must be 100%. Okay, then we can also put the box here. Okay, so for example, you have a set of assets, you have 5 assets. You can impose that asset 1 should have a minimum of 10% and a maximum of 20%. Also, asset B should have a minimum of such and such. Okay, so that's using the box function. Okay, it's like putting the weight of your assets in a box. So imagine, let's say Apple. So Apple can have, let's say, 30% and minimum and up to 60% maximum. So it's like putting Apple in a box where it is contained. Okay, it can go as low as 30% weight, or it can go as high as 60% weight. Okay, nothing more, nothing less. Okay, it cannot have a weight of 65% because of the box constraint. It cannot have a weight of 25%, again, because of the box constraint. Now, long only, okay, make sure that the weights of your assets are all positive. Okay, so which means that there's no shorting. Shorting will not be allowed. When you say short, okay, it means that the weight can have a negative value, negative weight. Okay, so now this is the function that we created last time. So take note, we're still using the port spec 1, because what's happening is that, remember, port spec 1 is like a container. Okay, and in this container, okay, maybe an analogy. So this is your container. This is your container, and the name of this container is port spec 1. So what we do is to add on conditions here to our container. Okay, so every time we add on to our container, this object updates. Okay, if you recall, if you take a look at port spec 1, so this is your port spec 1, sorry for the shortcut. Okay, to run optimization, you'll have to add constraints there. You'll have to add objectives. Okay, so every time you add something to this container, this specification container, it updates. Okay, it updates its model. As you can see, I'll clear this here, class. Remember port spec 1, this one? What does it contain? Okay, it contains several things. It contains constraints. It contains objectives. Okay, so those things we put in our port spec 1. Okay, So let's do this. The first thing that we add is constraints. And some of the constraints that we can put is full investments, weight sum, box, and long only. Here, okay, we're putting weight sum. And what do we do with weight sum? We can identify there the minimum sum and the maximum sum. So this is weight sum. So this is, okay, this is not full investment. Okay, because full investment, if I type here full investment, it means that strictly the sum should be 100%. Here, weight sum is a relaxation. So it will allow a solution where you have 99% of the weights or 100%, 101% of the weights. So for example, you can have Apple 55% and Google 46%. If you add that, that's 101. Okay, and that solution will be accepted. Or we can have 30 Apple and then 69% Google. If you add that, that's 99%. So R will generate a solution which is acceptable because we have set that the weight sum should be minimum could be 0.99 and maximum could be 1.01. Okay, so I hope you understand that this is a refinement of the full investment, which is quite strict. Okay. All right. So we have here, okay, then another constraint that we can add is if we want to make sure that the weights, no short sales, okay, that the weight should be all positive, no negative, then we put here type long only. Okay, so the long only constraint will make sure that the weights, for example, you will not have a solution where weight 1 and weight 2. Take note, class, again, to remind you, here, what R will be solving are the weights. So how much weight will be for Apple, how much weight will be for Google, okay? So these constraints that we have set, okay, make sure that for the weight sum, the sum of this could be 0.99, but no lower than 0.99. Okay, so it cannot, because this is minimum and the maximum is 1.01. So my illustration a while ago was Apple can have 0.60 and Google can be 0.39. That's okay because the sum of this is 0.99, or it can be 60 and 41, for example, because the sum of this is 101. Okay. However, because of this long only provision, okay, it cannot be that Apple is 102, okay, and then Google is minus 1%. 102 and minus 1, although the sum is okay, it's 101%. However, it violates the long only constraint. So this is not possible. This is okay as far as weight sum is concerned. But take note that we have several constraints there, here. But one is long only. Another one is weight underscore sum. Okay. And another one that we inserted here is box. Okay, so this is telling us that, so this is for all the assets because we can have a box for Apple, separate box for Apple and separate box for Google. Okay, so let's do this. Okay, I hope, I don't know if I can run here the, okay, I'll see. I'll first delete this. Okay, I showed you, class, add that constraint. This is a function that it's very important in portfolio optimization. So it would be good for you to review what's inside this add that constraint. So I'll wait for here at the help function here, class, add constraint. So this is from portfolio analytics. click this one, okay? And this one, we discussed this, right, class? Okay, weight sum. Okay, this is the full investment. Okay, as we said, the minimum sum for full investment is 1, and the maximum sum is equal to 1. So it's very strict constraint that the sum of the weights should be 100%. Then we have this dollar neutral. This is used for certain special cases that the minimum sum should be 0 and the maximum sum should be 0. So practically, it's telling us that the sum where the minimum or maximum should be 0. And the box underscore constraint, and also long only. Okay, long only means the minimum is 0 and the maximum is 1, which means that all positive. Okay, so if I take a look here, box constraint, I'll click this. Okay, so here is an example below. Okay, take a look at this one, class. Okay, so this is your spec, class. Type is equal to box. And then you have here, okay, you have here 4 assets. Asset 1, asset 2, asset 3, asset 4. So you're saying that for asset 1, the minimum should be 5%. Asset 2, the minimum should be 10%, 8%, and 6% respectively for asset 1, 2, 3, 4. And the maximum should be no more than 45% for asset 1, no more than 55, no more than 35, no more than 65 for asset 4 respectively, class. Okay? So, but you can also put a blanket minimum maximum for all the assets. So if you just put 0.05 minimum and maximum 0.45, it means that for all the assets, it will be minimum of 0.05, maximum of 0.45. And you can, as I said, you can specify it on a per asset basis. So here you're concatenating the four values of the assets for the minimum and the maximum. Okay, I'll pause for a while, class. So far, are we clear on that? I have your feedback, class. Maybe I'm going too fast, although this is a review. Okay, we just want to be very familiar with the coding, with the formulation for portfolio, class. Feedback, please. Are we okay so far? Okay, good. Thank you. Okay, no questions? Okay. All right. So in our case here, we have, okay, where's that? So if we're going, for example, if we're going to follow that, let me just illustrate. Minimum is equal to, okay, here, class, right? Type is equal to box, and then minimum is equal to, let me copy this, for example only. Okay, since we only have 2 assets, then we should have here, okay, we should have the minimum is equal to C. Okay, if you want to specify different limits for Apple and Google, we should have your minimum is equal to C, let's say 0.1, okay, comma, and 0.20, for example. And then comma, okay, let me just for purposes of illustration, control, copy this, control C, just to illustrate that in our case, type is equal to box, and then here you'll have minimum. Let's set different minimum C. Let's say 0.1 and 0.15, for example. Okay. Just like this one, class, right? See. And then on the other hand, the maximum will be okay. It can be only 0.7, which means for all 7. Or you can identify this one to be 0.5, okay, 0.7. So there you go. That's how you'll specify minimum and maximum for each of your assets. In our case, 2 assets. Okay? All right, so here it's both. Minimum is 0. We can change this to be, if you don't want, because if you put minimum is equal to 0, then it's possible that one of your assets will be 0. Okay? Is it possible for it to have 0? What do you think, class? If you set minimum here is equal to 0, is it possible that your apple, for example, will be 0? Can you answer that, class? Yes or no, please, in the chat box. May I see? Yes or no? Okay. Again, let's say this is what we're going to use. Minimum is equal to 0, maximum is equal to 70. And since we're only identifying one, then that means this is both for Apple and Google. So the question is it possible that a solution will be generated where Apple is equal to 0? Can you please chat in the chat box? Yes or no, please? Yes, if you're agreeing that it's possible that Apple can have a weight equal to 0. And okay, no, if that's not possible. Take note, we place their minimum is equal to 0. Yes or no, class, please? Just your guess. I'd like to know. Yes or no, please, class? Let me repeat my question. Okay, we set this box constraint where it tells us the minimum weight that an asset can get is 0 and the maximum is 0.7. Now, my question is, if we're going to set this, we're going to run this, is it possible that one of the assets, let's say Apple, will have a weight equal to 0? Okay, yes or no, please? True or false? Plus, waiting for your response. False, okay? Yeah, minimum, di ba? Minimum constraint, 0. So my question is it possible that the solution, because here, what R will determine is the weights of Apple and the weights of Google, because that constitutes your portfolio. Okay? Now the question is, since we're setting the minimum to be 0, then is it possible that Apple will have a weight equal to 0? Okay, the answer yes. Okay. True, true, true. Okay, good. Thank you so much, class. The answer is no. Why? Why? Cannot be. You know why? If Apple is 0, okay, then what will Google be? Okay, remember, you have a weight sum constraint. So the sum could be 0.99 minimum or 1.01. So if Apple is 0, then the least that Google should be is 0.99. Diba? Because if you add this class, 0 and 0.99 gives you 0.99. That's okay. However, we have a ceiling of 0.7. We're saying that any asset cannot have a value, a weight equal to 70%. Okay, so therefore, this is also a minimizing value. So if we put, let's say, 0.7 to 0.7 for Google, okay, because the maximum for any asset is 0.7. Okay, so where's that annotation? What happened to my annotation here? Okay, so if 0.7 is the maximum, and let's say we max it out for Google, then therefore Apple should be at least 0.29% or 29%, because the minimum sum should be at least 99%, at most 101%. All right, so therefore, with this constraint, although it seems that from just the look of it, we might be thinking, Apple can have 0%, 0% weight. Oops. But don't forget the other side. There's a maximum. Okay? There's a maximum of 70%. So it's not possible for Apple to have, or Google for that matter, to have 0%, despite the fact that we're putting here a minimum, okay? Now this will just make sure that there should not be any negative value. Okay, so that will reinforce the long only position. Okay, again, may I pause for a while, class, and may I have your feedback if that's clear? Is that clear, class? Did that make sense, class? Okay, good. Okay, good. Thank you. Okay. So for me, I would have placed here maybe if you really want to make it 70%, then maybe the alternative should be make this, let's say 0.3 instead of minimum 0. Okay, because if you put here, anyway, that's what will happen anyway. Okay, it's equivalent to that one because you're maxing out 0.7. Okay, so this is the constraints that we placed in our portfolio. Okay, so I'll run this. Okay, I'll run that. Is it running? Okay. Sometimes I need to run it. All right. So if I check my port spec class, this one, what do you notice here? Now we have constraints length of 3. Before it was 0, right? And if I click this, notice what happened to our port spec. The constraints that we placed there were added. Here class, weight sum, box constraint, and another box constraint, right? If I click this one here, weight sum, minimum sum 0.99, maximum sum 0.01. Okay, this one, the next box constraint here. Okay, long only. Okay, so that's a type of box constraint actually. Long only means all positive. There class. Minimum 0, 0 for Apple, 0 for Google. Maximum 1 for Apple, 1 for Google. So that's what long only means, only positive. And lastly here, there's another box constraint here, class. Click this one, and then you have box. Okay, minimum 0, 0 for both. Okay, and 0.7, 0.7 for both, because that minimum 0 and maximum 0.7 is for both of the assets. Okay, all right, so those were the constraints that we added. Now, objectives, it's still 0 because we haven't added the objectives. Okay, so now we are now building up our specification. Okay, let me pause for a while and ask you so far, class, is it clear so far? You can see how we are building up our portfolio. So that's what's happening to our portfolio spec, which I said is like a container. Okay, a container where you put in the elements of your portfolio. Okay, may I again have your confirmation, class? Feedback if it's clear so far. Okay, good. Okay, good. Okay, so let's go back here. The third step, class, is add objective to the portfolio. So let's have a quick review. Step 0 is creating your portfolio. Okay, for us, it's port 1 consisting of the log returns of Apple and Google. And then step 0, and then step 1 will be to create our container, our holder, our container specification. And then step 2 is add our constraints. Okay, we have some constraints to choose from. Step 3 is add the objective. All right, so here, class, add that objective. So why don't we see add that objective? Control enter. So this is also from portfolio analytics. And then it will again put here. Here, class, add that objective. All right, let's click this, Portfolio Analytics, and then General Interface for adding optimization objectives, including risk, return, and risk budget. So that's what this function does, okay? So add that objective. It includes the constraints, the type, the name, etc. Okay? And then here, the type can be, okay, return, it can be risk, it can be risk budget, it can be quadratic utility. So we'll just limit ourselves to return and risk. Okay, so there are examples here. For example, this one. Okay, so what happened here was, okay, so these are your returns, and then we have here, we first added the constraint, full investment, and then long only, and then we added the objective. Okay, so where do you add the objective? You add the objective to your portfolio, to your spec. And for example, here, quadratic utility, here, the objective is return, okay? And the name is equal to min. So you use this when you're trying to optimize or maximize returns, and you use this if you're trying to minimize risk. So type is equal to risk and name is standard deviation. So these are partners. When the type is return, the name is min. That's the usual combination. And add that objective to your specification. Okay, this is our port spec. Okay, so you can also make the object as risk minimization. So the type will be risk and then standard deviation. Okay, this is another type of risk. Okay, let me see. Type, name, I think we should see it's not here. ES, I think, is expected shortfall, I think, yeah. So it's expected shortfall. But in your case, class, we will just use the basics. Okay, we will not go into more deeper. Okay, that's just like this class. You can create a risk budget out of that. Minimum portfolio risk 0, maximum portfolio risk 0.6. You can identify. Okay, you can identify up to what are you willing to create, no, for your portfolio. All right, so I just wanted to show you that the help function of R is really very helpful, because you can actually copy this, okay, copy it to your R markdown file and run it and see what happens. Okay, so we go now here. Okay, two types of objectives. We can maximize the returns or minimize the risk. Maximize. Okay, so here, let's add now an objective, and that objective is to minimize the risk, which is to minimize standard deviation. So I'm creating a new object, just to preserve the original one, port spec 1, which contains the constraints. So I created a new one where I'm going to add the objective, so that later on, when I add a different objective, I can still use port spec 1. Okay, I hope you got what I mean. Let me illustrate that. So let's say this is your port spec 1, right? This is your container, port spec 1, and it contains the constraints. It can add constraints. So when you add here an objective, okay, then that objective will be now part of your specification. Now I want to preserve this. I want to preserve this container. So I'm going to create another one. Okay, I'm going to create another container. Okay, so this is what this means. Port min var. So it's also port spec 1. So it contains the constraint class. However, I'm going to add an objective here. I'm going to add an objective here. So this container now contains objective. However, this one still does not contain the objective. It's still preserved because later on, I'm going to use this again and create another container, but this time add a different objective. Okay, as you can see, you can add different objectives. So I just don't want to lose this object when I add a new objective here. Because when I add an objective here, then this object already contains that objective. And I want to preserve the original one. So I'll just get this again and then add another objective, get this again, add another objective. Okay. So I hope you get what I mean. Okay. Uh, okay. So let me just clear this. So we're creating this object, portfolio minimum variance. So that's why I use this. Portfolio min var. Okay, and it's equal to port spec 1. And take note, I'm preserving this. Okay, so port spec 1 will still be there, which contains the constraints. So I'm now going to add in this object, which contains our port spec 1. Okay, so let me run this first. Run this, and we now have this object, port min var. Okay, and if I print this, it's exactly the same as port spec 1 here, class. The constraints, there are 3 constraints. Okay, I'm sure you're getting it, class. Okay, so the objective will be type is equal to risk and name is equal to standard deviation. Okay, and let's view this. Run. I ran this already, class. Okay, anyway, I'll just run this one. Okay, so take note. So you have the assets here, you have the constraints, the 3 constraints here, and then now you have this objective. So you have now an added objective, which is, the objective is, okay, the objective is risk objective. Okay, portfolio risk objective. There you go. Okay, so this is now our port min var. Okay. Now, the next step now is to optimize the portfolio. Okay, optimize the portfolio. Of course, time flies so fast. Wow. Question mark, optimize that portfolio. So what will R do is that it will find the portfolio that will provide the best solution for our objective. Our objective is to minimize risk, right? Let's look at what this function does. We'll enter. And once again, this is from portfolio analytics there. So it changed already, multiple portfolio optimization. Okay. So here are examples. Okay, add that constraint, we know that. Then add that objective, we know that. And then, so here you can see that there are different objectives here that this example is doing. And then there's even this combining of portfolios. Okay, you can see that you have a combination of portfolio, which is to minimize standard deviation, to maximize mean, average, minimize standard deviation, average standard deviation, minimize expected shortfall. Okay, you have several portfolios here that can be combined. Okay, so I'll leave you, class, to try to explore this. Okay, we'll just go to the basic here. Okay. So where are we now? Here, class. We now go here. Okay. So what will happen is that R will generate several portfolios. Okay. And the function is optimize that portfolio. And it requires us to define R is equal to, what's our object? Our object is port 1. Okay, this is a portfolio. And then our portfolio is, okay, this is our port min var. Okay, this contains our specification plus the constraints plus the objective. And then for optimized method, there are several methods, class. You have random, you have ROI, you have DE optimization. So R has quite a number of uh, of methods that can be used. Okay, so let's run this. Okay, so that we have the same solution. Set that seed 111. Run this. Okay, take some time. Okay, uh, let me just put here tick. Okay, can you make sure that your tick and talk class TikTok package is loaded? Because oftentimes, especially in machine learning, we're going to need that. We'd like to compute how many seconds uh, did it take R to generate this. So I'll run this again. Okay, run. It's still generating the portfolio, our optimal portfolio. Okay, it took 24 seconds. Okay. We were supposed to discuss another example. Okay, let me just, anyway, later. I have 5 minutes. Wow. So let's view this. View min var opt. Okay, so let's see. What do you have here? We have this. This is our portfolio, right? Okay. Uh, this is our weight class. Okay. This is our solution. So the optimal portfolio where you minimize risk or minimize standard deviation is 48% of Apple and around 51% of Google. Okay, so this satisfies the condition of minimum 0 and maximum 70%. This satisfies the condition that all are positive. Okay, and if you recall, these are our objective measures. The standard deviation is 0.016. This is the lowest standard deviation that can be generated from your portfolio. So what happened was R created, uh, came up with a optimization solution where it tried to find combinations of the weights of Apple and Google. It tried to combine several combinations. It tried to find combinations of the weights, and then it looked for the combination that would minimize risk, standard deviation. And this is the solution. The optimal solution is where the standard deviation is at a minimum. And that combination is 48% Apple and 50% Google. You cannot find any other combination portfolio of Apple and Google that will give you the least amount of risk. Okay? So you have here standard deviation. The optimal solution is the least standard deviation is around 1.6%. Okay? And what's our portfolio here? Again, class, our assets, okay, our constraints, our objectives, data summary, okay? So this just tells us when it was running the model, this was the first value of the weights, and this was the last value. And it took 23.43 seconds, which is this one. There's a bit of difference. This is our TikTok class. All right. So that's for minimum variance. Okay, now for this one, we can extract the weights class, extract the optimal weights and other measures. So we use this function extract weights of our object mean var op1. Okay, so let's run this. Control enter. All right. So this one class, we were able to extract the optimal weights. Okay, how about the objective measures? Control enter. Right there, class. Standard deviation is 0.016. Okay, if I run this, Apple, Google, 48%, 50% respectively. Standard deviation is 16%. Okay, so that's our solution class. That gives us the portfolio that gives us the most minimum returns. Okay, so here you can plot the chart. Okay, so this will just give you a horizontal bar chart. Okay, all right, then let me go down here. Okay, now you can also create another one class. Another one here class. Not sorry here. Where's our we have another objective. Let me go to the other one. Here, class. Here. What about if it's maximize returns? Okay, so here I'm going to create another portfolio, port mean. So this is the average mean var. Okay, and take note. Okay. All right. So I'm adding both. No? What we should have done is here first class here. Okay. Anyway, let's just combine it. So combination of risk and standard deviation. So I'm creating another one plus another portfolio. And let's run this. Okay, my mouse. There. It's running. All right. So take note, our objectives now are two, risk and return. Okay, so it's now combination of risk and return. All right, and then let's run this. I'll leave you class to create the portfolio where you're only maximizing the returns. And you'll see that it's a different solution. Okay, okay, it's already time. Okay, so we weren't able to discuss the efficient frontier. So what I'm going to do is just, because on Tuesday we'll already have to start with machine learning. So anyway, it's a short discussion about efficient frontier. So you can do some research also, class, about how to create now your efficient frontier. You can try to run this class because this gives us the efficient frontier. And just to end this discussion, what's the efficient frontier? The efficient frontier class, okay, is a plot of your risk and return. So this is your return, okay? And this is your risk, okay? And it plots class, for example, this one. So this, you have several points here. This one comprises your weights. So several combination, nothing here, okay? Several combinations. So for example, this is weight 1 and weight 2. What is the equivalent return and what is the equivalent risk? So you'll notice that for any combination here, any asset here, any weight combination, in this region, there will be one portfolio that will perform better than any point outside your efficient frontier. This is your efficient frontier, this line. Why? Because this weight, this portfolio, weight 1, weight 2, has a higher return than this portfolio. Okay, so this is the return of this portfolio. This is R1. This is the return of this asset here. R2. So you notice that R1 is greater than R2. However, they have the same risk, sigma. Okay? So asset 1 and asset 2, portfolio 1 and portfolio 2 have the same risk. However, asset 1 has a higher return compared to asset 2. So that means, class, that the Sharpe ratio, which is a measure of the return over risk, the Sharpe ratio of R1 is higher than R2. So, and Sharpe ratio is a very important metric in assessing which of your portfolios are best. The best ones are here, class. This is what you call your efficient frontier. Well, actually, this whole plot is your efficient frontier. And this one, class, this one is also a bad area here. Why? Because this asset in this line, take a look at this one. Asset here on this side. Okay, this portfolio has a very small return as compared to this one, right? And they have the same risk. Okay, so the best portfolios are those in this area, and that's your efficient frontier, class. Okay, and that's what you need to show in your paper. This one, this plot. All right. I'm sorry, class, for having extended my time. Okay, so thank you so much.